Today, we're seeing the dollar pull back, so it's bouncing. But it's a tough scenario for Bitcoin here, and I do think it's going to ultimately go lower. Doesn't mean if the dollar pulls back a little bit more, it won't have a small bounce. But I'm hard-pressed to find a scenario where Bitcoin doesn't at least go to 12 to 13,000 before putting in a bottom. And I have a worst-case scenario that's well below 10,000 on Bitcoin. So I think it's important for Bitcoin investors to realize that this is the first bear cycle that the Fed is not printing money during, right? And so you have to take that into account when you're doing your cycle. So if previous cycles saw an 80 to 85% correction, you got to think this one would at least do 80 to 85%, which would be 12, 13,000. And it might even do more. The more upside on the dollar, right? More people hide in the US dollar for safety. And so that, again, just right there is a negative for equity markets, for crypto markets, for gold. Nicely enough, we have potentially seen a major reversal in the dollar today. So we might be seeing a short-term top there, which would be positive for risk assets. Because what you're seeing is essentially the Fed is trying to lead this push, and they're talking so aggressively hawkish. Now, I believe it's a lot of talk. I'm curious, once we tick into recession, how quickly they back off from this hawkish talk. But I think they're trying to talk a tough game to make sure that inflation kind of stalls out here and does come in. But I do think raising rates sucks money out of the system, right? So just like printing and lowering rates drives money into the system, it makes money free or at least cheap. The opposite is occurring. So it's a supply-demand economics problem where when you take dollars out of the system, inevitably the dollar should strengthen. And especially since we're acting more aggressively than the ECB or the Japanese central bank, it's going to strengthen the dollar against those currencies. Yeah, I think so. And again, it's hard to know how much. I don't know longer term. It's very hard to predict the longer term movements, like in 5 years, 3 years from now. But in the very least, you have to look at the euro and say it's due for a technical bounce. I would just pinpoint this level. Let me show my chart. So a couple levels that I would pinpoint as resistance if the euro starts to bounce. This one would be one of them. You can see these pivot lows right through here, and then just above that. So I think you could get a bounce on the euro, but it probably would run into major resistance around 105 to 106 on the euro against the dollar. Part of it is the psychology of the market. So one of the key components of a technical trader is looking at the mental state of investors who are massively investing in a market. And what we saw was kind of this culmination of fear from Friday when that news hit. We saw the stock market really sell off sharply when the pipeline was announced that it was going to be fully shut off. And over the weekend, all of that fear kind of stewed with a 3-day weekend here in the US. So it kind of created this like max pain level where you inevitably get a reversion or reversal off of this kind of level. Then you throw in these trend lines that we showed, whether it's the Japanese versus the yen versus the dollar or the euro versus the dollar here, and you start to think, okay, this could at least be a short-term pivot point on the charts. And I think, again, just looking at the dollar chart, the Dixie, you've had so much major upside in the charts on the dollar that it's due for that kind of relief pullback. It's just been pushed too hard, too fast. Each rate hike takes a certain amount of time to work its way through the economy, right? So if you hike 3 times in a row, 75 basis points, and then all of a sudden in 6 months, we're in a deep recession, ask yourself, how do we get out of that recession? Because every past recession, the Fed has come to the market's rescue. QE, QE1, QE2, QE2. And I mean, you just went on and on all the way through COVID with printing money and lowering rates. And so the Fed can't do that anymore with inflation as high as it is. So I really hope they're careful. I think that they're starting to see those signs of weakness creeping in like they want, the inflation numbers coming down. And I think that that would be the goal here, to start that. They can always do 50 again later in the year if they want to, but starting to just bring it down a notch would be a very confidence boosting thing for the economy and for the markets. My thinking of and why I'm net longer term bearish is that I do see us going into a recession. Even if they start kind of coming down on the hikes less and less, we're still headed into a full-fledged recession. And again, I think once the market realizes the Fed can't bail us out of this recession, the market's going to freak out. It's going to say, okay, this could be a long, drawn-out recession making up for all the lack of recessions that we've seen over the past 10 plus years. And that could be this kind of stagflationary kind of period in the markets. And I think that's the culprit for the next big leg down that takes us down to the pre-COVID low highs from 2020 and even below. Yeah, so I think into year end or early 2023, your downside target on the spiders, for instance, you're looking at that pre-COVID high. So this is kind of my target. You're looking at like 338-ish or so. But I do think before all is said and done, meaning that whether it's 2023 or 2024, this market will go below there and go quite a bit lower. And I would not be surprised if we find ourselves retesting something down in this range quite a bit lower. Like you could be looking and saying, hey, markets are net down from their all-time highs, well over 50%. From the highs put in when stimulus was at its max, when the government was sending checks, and when money was essentially free. So I think there's a reckoning here that's going to ask yourself, how does the economy get itself out of recession once it gets in? And what if it gets bad? And that's going to be a real kicker, right? If we get into a bad recession, unemployment starts spiking to 5, 6, 7%, but inflation is still 4%, let's say. What ends up happening then? How do we handle it as an economy? And I think that's going to be all out panic in the markets when that happens. Mm-hmm. Yeah, I do think so. I think the miners have been maybe not abnormally, but they've been punished so much more than gold itself, because they get hit by inflation, right? So yes, they're mining gold, but gold's not going up at the same rate as inflation at this stage. And so what's going on is they still have to pay their workers more money due to inflation. Their materials cost more money. Their drilling equipment costs more money. So they've been obviously getting hammered. But if you see inflation continue to come down and the Fed pivots, I think that's the key there for the miners. And the miners at that point would perform really, really well. I got to show you this chart on the gold miners, because a huge flashing buy triggered on this. And much like silver's chart, it's almost identical. But look at this. Here's a trend line. We just tagged it. Is bouncing. So I think, again, the miners look really good here. And if I'm right on this Fed pivot, you should see the miners do very, very good. Very, very well. Yeah, so what we've seen is oil just continue to collapse. And historically, this is very normal. It's like you see kind of this reaction. Like in bull markets, anything slightly bullish will cause a mega spike. In bear markets, you can have good news like them cutting production, which should drive price up, and instead it drives price down. And I think what you have to keep in mind is that we're on the precipice of a global recession, whether it's whether it's Europe or whether it's someone else. It looks like everyone's headed towards slower economies. And again, you could cut 100,000 barrels of oil off the table. That's nothing compared to a global recession and the amount of oil being that won't be used. I mean, think about filling a bucket with one drip of water, which is the 100,000 cut. I mean, it does nothing. So I think it's more lip service. They're trying to kind of keep prices up. And I think it's also important to recognize that, like, China's still going to buy all the oil that Russia wants to sell, just at a discount. Like, this is one of the things which made me so bearish on oil when we saw the spike to 130 and 120, is because it's not like that oil was really going off the market. It was just going to get sold at a discount, and people just didn't understand that. Panic and greed kind of drove prices up. But again, the impact, and this is one of the big things I think Putin is miscalculating, is that what he's doing with Europe is going to drive Europe to become energy independent, whether it's nuclear or it's alt energy or it's their own drilling. And in 10 years, no one's going to need to buy the oil from Russia. And so short term, I know he's fighting a battle, he's fighting a war, but it's a big longer term miscalculation. And OPEC does this too. And sorry to get off on a rant, but the fact that OPEC wanted to keep prices above $100 a barrel or 120, huge miscalculation. Not only are you going to force the world into a recession where they're going to use less, but it's